Welcome to the Strategy Sync YouTube channel. Please subscribe and like to hear new book summaries. Today we're jumping straight into one of the most pivotal, most frantic moments in financial history.
We're talking about the months surrounding the 1929 stock market crash. And this isn't just another retelling.
No, this is a deep dive built on a book that gives us this incredible, almost fly-on-the-wall narrative.
Exactly. It draws on sources you just don't normally get to see. We're talking private letters, personal diaries, and maybe most importantly, confidential Federal Reserve Board minutes.
So this lets us get beyond the famous historical accounts like Galbraith's The Great Crash.
Right. We can actually step inside the rooms with these titans of Wall Street as their entire world is just, violently unraveling around them.
And the book opens with such an intense scene. It puts us right there with Charles Mitchell. He's the president of National City Bank, this towering, swaggering figure.
He was trying to make it the biggest bank in the world. And he's returning to his office at 55 Wall Street. Outwardly, he's, the picture of confidence. He has to be.
But inwardly, the book says you could see the dread in his posture. He gets to his massive office, and there are the internal reports waiting for him.
And they are terrifying. The bank had been forced to secretly buy tens of thousands of its own shares.
Just to keep the price from collapsing.
It's the perfect way to start because it shows you everything. This man, Mitchell, who could process financial data like a machine, he knew instantly what that meant.
He knew that everything he had built was, and this is a quote, at grave risk of collapse.
And that contrast, the public confidence and the private terror, that's really the mission for us today, for you, the listener, to show how the entire financial system in 1929 was this grand facade.
Okay, so our mission for you, the learner, is to unpack that intricate web. We're going deep into the financial imbalances, the political wars between Washington and Wall Street, and just the collective delusion that fueled the whole thing.
We're looking at a time when optimism wasn't just a feeling. It was a drug. It pushed the economic machinery to the very edge of its capacity, running red hot.
And to really get the violence of the fall, you have to understand the absolute confidence at the peak, the zenith of optimism.
And no one embodied that better than Charles Mitchell. Sunshine Charlie, they called him.
He wasn't a guy who believed in slow growth, was he?
Not at all. His ambition was almost, you could say, maniacal. He wanted National City to be the biggest bank on the planet, to dethrone London, make New York the center of the universe.
And that ambition led him to make these huge high-stakes moves.
Which brings us right back to that financial time bomb we mentioned at the start, the merger with the Corn Exchange Bank.
Right. A huge historic deal.
Yeah.
But the way it was structured was just incredibly dangerous.
It was. So Corn Exchange shareholders had a choice. They could get $360 in cash for each share. Or they could swap their shares for shares in National City. But here's the catch. That swap only made sense if National City's stock stayed above $450 a share.
And at the time, it was trading higher, right? Around $496. So it looked like a great deal.
It looked fantastic. But here's the secret. The huge secret Mitchell was hiding. National City did not have the cash. They couldn't actually pay everyone out if the stock price dropped and everyone wanted the $360.
Wow. So that put this incredible pressure on him to keep the stock price up.
Terrifying pressure. So his traders were given secret orders, a continuous massive campaign to buy their own stock. Their only job was to keep that price artificially propped up above $450 until the deal was done.
That's desperate financial engineering.
It was. The book reveals that at one point, Mitchell even offered to personally borrow $12 million, which is way more than his entire net worth, just to buy stock himself. He was putting his whole family's future on the line.
It really tells you everything about the culture of risk he created.
Yeah.
And while this is all going on behind the scenes, he's living this incredible life.
Oh, the modern gentleman. Picture this. A 5-story Italian Renaissance palazzo on Fifth Avenue.
Staffed by 16 people.
16. A butler, a valet, footman, 2 laundresses. Just for his family. This wasn't just being rich, it was performance art. It was audacious.
And his whole philosophy was seen as heresy by the old guard.
Right.
J.P. Morgan and those firms.
Completely. They were all about railroads, established industries. Mitchell was a pioneer. He was betting on new things, especially utilities, new technologies. He even advertised in the newspapers, which was just not done.
And his wife, Elizabeth, she played a huge role too.
She did. She brought this cultural legitimacy to all that financial swagger. She was an accomplished pianist, hosted these big musical evenings evenings.
There's that great anecdote about her and George Gershwin.
It's fantastic. Gershwin had this offer to write another Broadway show, which meant a lot of money, fast. But he wanted to go abroad to study and write something new, more complex. He was torn.
And Elizabeth told him to follow the creative path. She said, if you don't, you'll probably just write a pretty bad show.
And he listened. He went to Europe and wrote An American in Paris. It just shows you how intertwined these worlds were. These financial titans weren't just moving markets. They were shaping the art and culture of the Roaring '20s.
Okay, so from Mitchell's new money aggression, let's shift to the old guard, to Thomas Lamont at J.P. Morgan & Co.
Lamont is such a different figure. Polished, patrician, impeccably dressed. He was the bridge from the old world of J. Pierpont Morgan, who could, stop a panic with a single nod.
To this new, terrifyingly complex financial world that was growing, as they said, beyond human comprehension.
He projected this air of absolute integrity, which was the Morgan brand. But even the house on the corner, as they called it, couldn't ignore the new craze on Wall Street.
They had to get in on the game. And their way in was the investment trust.
And you have to understand this concept to get the crash. The investment trust was basically leverage, packaged, and then repackaged.
So break that down for us.
Okay. A trust would raise money from the public, buy a bunch of stocks, and then borrow even more money against those stocks. That's already high leverage.
But then it gets crazier.
It gets much crazier. Promoters started launching a second trust whose main purpose was to buy shares of the first trust. So you had trusts buying other trusts. It was marketed as safe, diversification.
But in reality, it was.
It was leverage buying leverage, a debt structure built on another debt structure. So if the actual stocks at the bottom dropped just a little bit, say 10%.
The whole thing would just collapse.
Instantly. It was structural fragility, just hidden by complexity.
And even the great House of Morgan was doing this.
Oh, absolutely. Look at the Allegheny Corporation deal. It was a $3 billion holding company for a railroad empire. Incredibly complex. And when they offered the stock to the public, it was $35 a share.
But not for everyone.
Not if you were a friend of the firm. The book shows that Lamont and the other partners could buy those exact same shares for just $20.
So they were making a massive profit on day one. Lamont himself bought over 18,000 shares.
He did. An instant paper profit of over $250,000, tax-free. But what's really fascinating is how he used this. It wasn't just greed.
It was a strategy.
It was a social and political strategy. He extended this secret discount to powerful people everywhere. Former President Coolidge, Secretary of the Navy, Charles Lindbergh.
Even his rivals, like Mitchell and Raskob.
Yes. And the telegrams were so casual, just, we were thinking of you and wanted you to share in this opportunity. It was influence peddling disguised as high-class friendliness.
Which brings us to our third king of optimism, John Raskob. A very different character again.
Totally different. Raskob was a true self-made hero. He'd helped build both DuPont and General Motors, and he saw debt and leverage completely differently.
Not as a danger, but as a force for good.
A moral force, even. He truly believed in democratizing wealth. This was a guy whose words could move the entire market. He once said GM stock should sell at 15 times its earnings, and it just shot up.
His belief was that American prosperity was unstoppable.
And everyone should get a piece of the action. This led to his grand vision in May 1929, the Equity Security Company.
The idea was to let anyone with a few dollars to spare, the working class, invest in stocks.
He said it explicitly. The working men and women of our country should not be shut out from the tremendous profits. It was a revolutionary idea.
And even though he thought the market was getting a little frothy, he went ahead with it anyway.
He did. His optimism also fueled his personal projects, which, we can still see today.
The Empire State Building.
Exactly. After a political setback, he poured all his energy and, frankly, his ego into building the world's tallest skyscraper.
It was a direct competition with Walter Chrysler, who's building his own tower.
It was. Raskob was determined to put a permanent stamp on the New York skyline, to cement its status as the financial capital of the world no matter what it cost.
So you have these three titans, all representing this boundless, unshakable certainty. But that level of certainty, it starts to blind people.
It absolutely does. And the first signs of doubt, the first feelings that things were getting absurd, they start popping up in some funny places, like with Groucho Marx.
Right. Groucho, who said he had zero gambling instinct, is at his brokerage and sees RCA stock trading at $535 a share.
And it just doesn't compute for him. So he asks his broker this very basic, very logical question.
How can it be selling for $535 a share and never declare a dividend?
I mean, it's the fundamental question, where is the value coming from? And the broker's answer is it's the perfect summary of the entire era.
He talks to Groucho as if speaking to a child.
And says, this thing is bigger than both of us. Don't fight it. Wall Street is a worldwide market now. It's just going to keep going up.
And Groucho listened. He invested, and he ended up having to mortgage his house to cover his losses.
And this was happening even as some people were sounding very clear alarms. In September 1929, the statistician Roger Babson gave this speech.
And he didn't pull any punches?
No. He said, sooner or later, a crash is coming, and it may be terrific. He pointed out that while a few big stocks were soaring, most stocks were actually declining. The overall economy was sick.
But nobody wanted to hear that. They wanted to listen to Professor Irving Fisher from Yale.
Oh, absolutely. Fisher was the voice of credentialed academic optimism. He's the one who famously said stock prices had reached a permanently high plateau.
He said he didn't see a 50 or 60-point break happening anytime soon, if ever.
He even said part of the reason for the prosperity was, get this, prohibition, because it made American workers more productive.
Yeah.
It's just amazing how authority was used to justify the speculation.
And if you need a final sign of just how delusional things had gotten,
Evangeline Adams, the astrologist.
the stock market seer, she was charging $50 a session, which was a lot of money then.
And her newsletter had 100,000 subscribers. People were making financial decisions based on the stars. When she was asked about the market on Labor Day 1929, she said, the Dow Jones could climb to heaven.
So beyond the delusion, there was also outright fraud.
Oh, massive systemic fraud. Take Michael Meehan and the RCA stock pool. He saw how obsessed the public was with RCA, the crown jewel of the new economy.
And he didn't see an investment, he saw a target.
A vehicle for a quick, guaranteed fortune. He set up this $12.7 million scheme to paint the tape.
Which means creating fake trading activity to make the stock look hot.
Exactly. He got a bunch of powerful people involved, William Durant, Walter Chrysler. A lot of them used their wives' names to try and hide their involvement.
So how did it work?
It was simple, really. The pool members just traded massive blocks of RCA stock back and forth among themselves. It looked like huge volume, huge interest. The financial papers start reporting that RCA is going to hit $100 very soon.
They drive the price up to over $109.
And then once all the excited regular investors have piled in, they pulled the plug.
They sold everything.
Everything. They made nearly $5 million in profit in about a week. RCA's stock price collapsed, and the public was left holding the bag.
And this was just one example of a system with basically no effective regulation.
None. President Hoover's whole philosophy was that the exchange should govern itself. It was a fatal mistake.
This all leads us to the big institutional fight, doesn't it? The Federal Reserve versus the New York banks.
And the man at the center of that fight is, again, Charles Mitchell. The irony is he was a board member of the New York Fed.
He was put there to muzzle him.
That's right. The Fed chairman, Benjamin Strong, worried about Mitchell's huge ego and his open contempt for their policies. Mitchell just didn't respect Washington. He trusted his own gut and the power of Wall Street.
So the Fed is trying to cool things down. They're worried all the available credit is being sucked into speculation.
Right, into the call loan market. That's how speculators financed their margin buying. So the Fed's plan was to raise interest rates, make it more expensive to speculate, and hopefully divert that money back to, actual businesses.
But Mitchell completely disagreed.
He thought the Fed was just creating panic and volatility. And this whole conflict just exploded in March of 1929. The market took a sharp dip.
And Mitchell decided to act on his own.
A completely defiant move. He publicly announced that National City would inject $25 million into the call loan market, basically offering cheap money to speculators, no questions asked.
He was directly undermining the Fed's entire monetary policy.
He was short-circuiting it. He said he had an obligation paramount to any Federal Reserve warning. He was providing bootlegging credit.
And this act of defiance created a very powerful, very angry enemy.
Senator Carter Glass of Virginia. Glass was one of the architects of the Federal Reserve System. And he saw Mitchell's move as a direct physical slap in the face to the institution he helped create.
He was furious.
Unbelievably furious. He said Mitchell should be incontinently kicked out of his position. I mean, the language is just so visceral. He immediately started plotting his legislative revenge.
While all this is going on, there's one last desperate attempt to stop the train wreck.
W.C. Durant, the founder of GM. He makes the secret trip to the White House in April 1929. He begs President Hoover to tell the Fed to back off, warns him that a disaster is coming.
And Hoover just dismisses him.
Completely. Hoover thought the market was too high, that a correction was natural and necessary. He still believed the stock exchange could and should regulate itself. He was wrong.
And so the clock ticked toward October.
And as the market hit its final dizzying peaks, the great bear was waiting, Jesse Livermore.
The newspaper said he was in practical retirement, but he was just being patient.
He was. Livermore had this philosophy, the curse of consensus. If everyone is certain something will happen, that's the time to bet the other way.
And he was seeing signs of trouble that Wall Street was just ignoring.
International signs.
Yeah.
He got word that a major British financier, Clarence Hatry, had been arrested for fraud, which was causing panic in London. And more importantly, he heard the Bank of England was about to raise its interest rates.
Which would pull money out of New York.
Immediately, he knew the machine was about to break. So he prepared for a massive short assault on the entire market.
How massive are we talking?
He shorted $150 million worth of stock. He maxed out his margin completely. His entire fortune was on the line. One more little push-up, and he would have been ruined.
The crash begins on Black Thursday, October 24th. And the first sign of trouble is the ticker tape.
It just couldn't keep up. The selling was so intense, the tape fell almost 2 hours behind. So across the country, no one knew the actual price of their stocks. It was blind panic.
And then the banks started raising rates on brokers' loans.
That was the final nail. Brokers had to make margin calls. They sent out these frantic telegrams, send cash immediately, or we sell your stocks.
Which just created a vicious cycle.
A death spiral. They sold stocks to meet margin calls, which pushed prices even lower, which triggered even more margin calls.
The crisis forces the big six bankers to meet at J.P. Morgan's office.
Thomas Lamont calls the meeting. They know it's not just about stock prices anymore. The entire banking system is at risk.
So they come up with a plan to show strength.
Right. They pool their money, initially $120 million, eventually over $250 million to buy up blue chip stocks. They wanted to fill the air pockets where there were sellers, but literally no buyers.
This leads to that iconic moment with Richard Whitney.
The hero of Black Thursday. He was the acting head of the exchange. He strode onto the chaotic trading floor and, in this loud, booming voice, placed a massive bid for U.S. Steel at $205 a share.
A huge public display of confidence.
Pure theater. And some people saw right through it. Bernard Baruch was asked to join the bankers' pool, and he refused.
Why?
He said the market was just too big now. There were too many small investors. He knew that not even the House of Morgan could stop this avalanche. He thought they were throwing good money after bad.
And he was right, because then came Black Tuesday, October 29th.
The day the bottom truly fell out, the market dropped almost 12%. $1 billion in value just vanished in the last hour of trading.
While inside, people were howling, collapsing.
And outside, Thomas Lamont is still trying to manage the story. He's telling reporters it's just a technical situation. One reporter said he looked like a man in a burning theater telling everyone to stay calm.
The contrast in what happened to people right after is just staggering.
It's mythological. Jesse Livermore's wife heard the news and assumed they were ruined. She started hiding their jewelry at the chauffeur's apartment.
And then Livermore comes home smiling.
And tells her, "Today was the best day I ever had in the market." He'd made $100 million shorting the crash.
While others were facing total devastation, Winston Churchill was in New York. He lost $75,000. He saw a man jump to his death from the Plaza Hotel.
And the tragic story of James Riordan, the president of a bank, a friend of John Raskob. He was wiped out by margin calls on his RCA stock, and he took his own life.
Which almost set off another panic.
A banking panic.
Yeah.
Raskob had to rush in, take over the bank temporarily, and get an emergency cash infusion from the Fed just to stop a citywide bank run. The system was on the brink.
The market had crashed. Now came the political war and the hunt for scapegoats.
And the first reaction from the Hoover administration came from his Treasury Secretary, Andrew Mellon. He saw the crash as tough medicine.
I was Caesarea medicine.
His view was that the crash would purge the rottenness out of the system. Liquidate everything, he said. He thought the people who lost money deserved it. Just let the system cleanse itself.
But Hoover couldn't stick to that line. Not as the Depression deepened and Hooverville started popping up everywhere?
No, by 1931, he's desperate. He calls a secret meeting of the top bankers and basically orders them to create a $500 million emergency credit fund. He warns them that if they don't act, Congress will, and it will be the end of capitalism as they know it.
But Carter Glass, the senator, he already had his target in mind.
He had never forgotten what Mitchell did. His one singular focus was structural reform. He wanted to separate commercial banking people's savings from investment banking Wall Street speculation.
Which leads directly to the Pecora hearings.
Right. And Ferdinand Pecora, the prosecutor they hired, he knew he needed drama. He wanted headlines that grabbed the public's attention.
And his star witness was Charles Mitchell.
Pecora just dismantled him on the stand. He exposed a tax avoidance scheme where Mitchell had sold thousands of shares of National City stock to his wife to create a huge paper loss.
A loss of almost $2.8 million.
Right, so he could wipe out his tax bill for 1929. Now, Mitchell insisted he did it to prop up the stock and that he bought the shares back later.
But when he was asked directly if the sale was to reduce his income tax, he had to admit it. Yes, it was a sale, frankly, for that purpose.
And that was it. Even though it was technically legal then, the public was outraged. A millionaire banker not paying taxes while the country starved. The damage was done. His reputation was destroyed.
Next up was J.P. Morgan & Co.
Even more theater. Pecora revealed that Jack Morgan and all 20 of his partners paid zero income tax in 1931 and 1932.
Again, legal, but it looked terrible.
And then things just got bizarre. Senator Glass complained the hearings had become a Roman holiday, a circus. So a circus publicist literally brought a performer, Leah Graff, the smallest lady in the world, to the hearing.
And put her on Jack Morgan's lap for a photo.
I mean, you can't make this stuff up. That one image, this powerful patrician banker looking foolish, it just cemented in the public's mind that Wall Street was a corrupt, out-of-touch joke.
And all that public anger finally pushed through the big reform. The Glass-Steagall Act.
What's funny is Glass himself didn't even want the final version of the bill. He wanted to protect firms like Morgan and punish firms like Mitchell's.
So what changed?
A rival banker, Winthrop Aldrich from Chase, pushed for the total, complete separation of commercial and investment banking. It was a competitive move as much as a reform.
And then the final piece was federal deposit insurance, the FDIC.
Right. Representative Henry Steagall insisted on it. Glass hated the idea, but Steagall knew it was the only way to get the bill passed. It guaranteed the savings of ordinary Americans.
It was a fundamental change to American finance.
And just when you think the story is over, there's the final blow to Wall Street's reputation. The hero of Black Thursday, Richard Whitney.
He turned out to be a fraud.
A complete fraud. In 1937, it came out that he'd been stealing millions for years. From his clients, from the stock exchange's own gratuity fund, all to cover his gambling debts and lavish lifestyle.
His own brother, a partner at Morgan, had to cover over $1 million of his debt.
The SEC later accused them of following an unwritten code of silence, of protecting the exchange's reputation over reporting a crime.
And Whitney, the hero, ended up in Sing Sing prison.
It was the final confirmation for the public that the whole system was rotten to the core.
So let's try to pull all this together. This deep dive shows the crash wasn't just a market correction. It was a complete breakdown of the entire infrastructure.
You had the Fed paralyzed, stock exchange overrun with manipulation, and the whole thing was floating on bootlegging credit and collective delusion.
And the real damage wasn't just the stock prices. It was the loss of confidence, the loss of credit.
Exactly. When asset prices fall, the collateral for loans disappears. Credit freezes up. People pulled their money out of banks and hid it under their mattresses. That total loss of trust is what turned a crash into the Great Depression.
But some things from that era of ambition did survive.
John Raskob's Empire State Building. It opened in 1931, the tallest building in the world. He won his race against Chrysler.
But for years, it was a financial disaster. They called it the empty state building.
It was. His vision of growth ran way ahead of the economic reality, but it endured.
I think the ultimate lesson from the book is about humility. It says that booms are inevitable, but the greater the heights of our certainty, the longer and harder we fall.
And 1929 was unique because that fall shattered the public's trust so completely, leading to the longest economic disaster in American history.
Which brings us to a final, really provocative thought. It's about the faith of Charles Mitchell and Jesse Livermore.
Right. Mitchell, the public villain who defied the Fed, he was disgraced, yes. But he eventually recovered his entire fortune. He lived a long, wealthy life.
And Livermore, the genius who called the crash perfectly, who made $100 million.
He lost it all again. It seems he was addicted to the action, to the fight, as much as the money. In 1940, completely broke, he took his own life. His final note said, "I am a failure."
So the question is, why did the man who broke the rules recover, while the man who understood the market perfectly perished?
It suggests that what really drives the speculative heart of the market isn't just about profit. It's something more obsessive, maybe more destructive, a human need for the action itself, for the chaos, and that's something no regulation can ever really fix.